While October showcased a historic moment for the gold market, with the precious metal achieving a record-high closing price, the market needs additional drivers to ensure sustainable growth, particularly in ETF inflows. According to insights from the World Gold Council, achieving a lasting impact on the market requires more than a momentary surge. In October, gold prices surged by nearly 7%, concluding the month at an impressive $1,997 per ounce. However, since then, gold has encountered challenges in maintaining its position around the $2,000 per ounce mark. December gold futures recently traded at $1,974 per ounce, experiencing a 0.73% decrease for the day. The gold market in October. October was a remarkable month for the gold market, marked by a historic rally that saw gold prices reaching a peak. The precious metal closed the month at an all-time high of $1,997 per ounce. This surge was attributed to various factors, including geopolitical uncertainty. However, despite the promising start, gold has struggled to maintain this momentum, with December gold futures recently trading at $1,974 per ounce, down 0.73% in a single day. This raises questions about the sustainability of gold's price growth and the need for additional catalysts. Analysts' perspectives from the World Gold Council. Analysts at the World Gold Council have offered valuable insights into the gold market's dynamics and the challenges it currently faces. Their assessments shed light on the various factors affecting gold's performance and the potential catalysts required for a sustainable rally. The search for sustainable growth. The analysts at the World Gold Council have highlighted the need for sustainable growth in the gold market. While momentary price surges are significant, long-term stability and increased investment are essential for the market's health. The current market situation calls for a more comprehensive analysis of the factors that can drive sustained growth. ETF flows and investment behavior. A critical aspect of gold's performance is the behavior of investors and their participation in gold-backed exchange-traded products, ETFs. The analysts noted that while speculative safe haven demand increased due to geopolitical uncertainty, long-term investors remained cautious about entering the market due to weak price action in gold-backed ETFs. The World Gold Council analysts emphasized the significance of ETF flows, as they have historically played a pivotal role in driving gold prices. Understanding the behavior of investors in this market segment is crucial for predicting future price movements. Factors influencing gold prices. The analysts have identified several key factors that can potentially influence gold prices and drive a sustainable rally. These factors include political risk, bond yields, the strength of the US dollar, and the performance of the equity markets. A sustained rally in gold would likely require the presence of one or more of these catalysts. Geopolitical uncertainty. Geopolitical instability has historically driven demand for safe haven assets like gold. The recent conflict between Israel and Hamas contributed to speculative safe haven demand, which temporarily boosted gold prices. While geopolitical uncertainty can provide short-term support for gold, its long-term impact depends on other factors. Impact of bond yields and the US dollar. Bond yields and the US dollar are critical factors influencing gold prices. A peak in bond yields or a weakening US dollar could provide a favorable environment for gold. However, these factors are subject to various economic and monetary policies that can change rapidly. Equity markets and recession risks. The performance of equity markets plays a vital role in gold's appeal as an investment. An equity bear market, combined with revived recession risks, could drive investors toward safe haven assets like gold. The analysts noted that these conditions could be conducive to a sustained gold rally. Investor sentiment and market potential. Despite the challenges facing the gold market, the analysts acknowledged the potential for growth. They highlighted that historical patterns, such as COMEX net shorts reversals, have often signaled positive developments for gold prices. These reversals have also preceded increases in ETF flows, suggesting that with strong investor support, gold could break out of its current trading range. Gold-backed ETFs, a weakest pillar. While the gold market shows promise, the weakness in gold-backed ETFs stands out. The World Gold Council noted that October's flows could signal a bottom in the market. Even though the market experienced its fifth consecutive month of outflows, the pace was slower compared to September. In October, 37 tons of gold, valued at $2 billion, flowed out of global gold-backed ETFs. However, assets under management increased by 6% due to gold's rally during the same period. Year-to-date, holdings in gold-backed ETFs decreased by 225 tons, amounting to $13 billion. The role of the Federal Reserve. The analysts emphasized the significant influence of the Federal Reserve's monetary policy on the gold market. The restrictive monetary policy adopted by the Federal Reserve has had a considerable impact on gold. North American markets, in particular, have seen outflows, with North American listed funds experiencing outflows of 27.5 tons, valued at $1.5 billion. The surge in Treasury yields, which presents an opportunity cost for holding gold, overshadowed the safe haven demand stemming from geopolitical risk and equity market volatility. Notably, the 10-year U.S. Treasury yield reached 5% during October, a level not seen since July 2007. European markets and stabilizing yields. On the European front, the World Gold Council observed that European listed funds faced outflows of 11 tons, valued at $622 million. However, stabilizing yields, as the European Central Bank, ECB, paused its 10-month rate hiking spree, contributed to the region's reduced inflationary pressure. The presence of geopolitical risks and a rising gold price helped limit the losses in European markets. The European situation underscores the complexity of factors influencing the gold market, as regional economic and political conditions play a significant role. Asian markets, a pillar of strength. Asian markets, particularly China and Japan, have been a stronghold for global ETFs. They saw inflows of 1 ton, valued at $81 million between January and October. This positive trend contrasts with other markets, where Turkey and other regions also saw inflows of 1 ton. Asian markets' resilience and continued interest in gold-backed ETFs demonstrate the diverse global landscape of gold investment and the varying factors at play in different regions. Potential catalysts for the gold market. In their analysis, the World Gold Council highlighted potential catalysts that could trigger a shift in the gold market. Lower equity markets were noted as a key factor that could spur renewed interest in gold. Role of equity markets. The analysts noted that the performance of equity markets is a crucial determinant of gold's attractiveness as an investment. While earnings projections may be optimistic, declining prices in stock indices, such as the Nasdaq, have raised concerns. The Nasdaq index, for example, has already experienced a decline of more than 10% from its mid-year peak, even during what is typically the seasonally strongest period. A more significant drop, exceeding 20% from the peak, commonly referred to as a bear market, could potentially stimulate increased interest in gold among investors. This would occur if investors perceive that buying into equity dips is no longer a viable or profitable option. Looking ahead, the quest for gold market catalysts. As we delve deeper into the dynamics of the gold market, it becomes evident that achieving sustainable growth and higher prices for gold requires a nuanced understanding of various factors. While October's historic rally was a moment of triumph, it was just the beginning of the journey. The role of investors, especially in gold-backed ETFs, remains crucial. Their behavior and the catalysts that drive their decisions are pivotal in shaping the gold market's trajectory. The relationship between gold prices, geopolitical events, bond yields, the US dollar, and equity markets is intricate and ever-evolving. To unlock gold's true potential, market participants must monitor these factors closely and adapt to changing conditions. As we navigate the complex landscape of the gold market, the quest for catalysts that can sustain higher prices and drive ETF inflows continues. Whether it's geopolitical developments, monetary policy shifts, or the performance of financial markets, the future of gold remains intricately linked to a multitude of influences.